That's the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's close. Got Sylvia Jablonski, Defiance ETF's CEO and CIO, as well as Yahoo Finance's Allie Canal, joins us here to break down the moves today. Allie, let's start with you on that close.
All right, well, we again have a record high for the S&P 500 and the Nasdaq Composite after those indexes closed in the green, extending those gains that we saw on Friday. We have the Nasdaq Composite up around 0.6%, same with the S&P 500, and then the Dow Jones Industrial leading the way higher, up about 0.6%. But we now are officially through the first 6 months of the year. So let's look at sector performance-wise and see which cohort of stocks performed the best here. And there is a fight between communication services and industrials duking it out for that number one position, but looks like communication services is our leader here. And if we take a look at a year-to-date chart, we dealt with some choppiness earlier in the year here. Now, this sector includes names like Disney, Alphabet, Meta, Netflix. Many of these companies have performed well throughout the year, outpacing the broader market. Meta in particular has had a year-to-date gain of around 25%, and we did hit all-time highs in that stock earlier in today's trading session. And then if we take a look at industrials, which again has performed very well, certain names within this sector like GE Aerospace, that surged over 55%. Boeing is up just under 20%, and RTX Corp rising about 25%, so helping lift that sector as well. And then finally, rounding out the top three here, we have XLK, obviously helped by shares of NVIDIA, Microsoft. Both of those names have risen about 15%. Also Palantir, which we'll talk about in the next half hour or so. That's been one of the best performing stocks. It's within the tech sector and helping to boost the overall viewpoint there when we look at the totality of these moves. And then energy, healthcare leading the declines along with this consumer discretionary. And this sector of stocks just hasn't been able to get things done. Some of the biggest laggards within this group include Tesla, down over 20% year to date. VF Corp, that's known for brands like Vans, North Face, that stock plunged nearly 50%. And then we also have shares of Nike, Starbucks, and Amazon, all underperforming the broader market. So this is our setup heading into the back half of this year. We've seen a ton of volatility, but it seems like those mega cap, high quality names, those are the names that you can find the best protection from amidst some of this turmoil. So we'll see what the second half of the year brings, Josh.
All right, thank you, Allie. Now I want to get Sylvia back in here as well. Before we chat, Sylvia, more on the first half as a whole, any takeaways from today's action?
Yeah, I think it's another positive day for the markets, right? It tells me that investors are thinking more about the future of the markets, the positive sentiment, and that some of the risks are behind us. So there's more of a focus on that than there is, say, on geopolitics, tariffs, inflation, the things that we were worried about before. And so this is, I think, all systems go for the markets, provided that Q2 earnings turn out to be pretty good, if margins are solid, if cost cutting is still at bay, and AI, CapEx, all of that stuff is, spending on that is increasing, revenues are increasing. We're in a good spot for the next few months.
We're in a good spot. Just for a second, though, pull back the chart. I'm just curious, Sylvia, if you looked at the first half, lessons learned, you think, for investors on that?
Yeah, lessons learned. I think we talked about it a little bit before too. When you have the market pulling back 20 to 30%, it is not the time to panic. It's actually the time to put money to work. You can do that by diversifying your exposure to the S&P 500. You could do an XMAG. You can put money in different alternative sectors, cryptocurrency, things like this, or buy Mag 7 stocks if you don't have any exposure to them, because usually these things turn, right? Recessions don't last for so long. Markets don't last for so long. And in this case, it just proved to be true. And we just saw lessons learned. Those opportunities to buy on dips are opportunities to actually buy on the dips and put your money into stocks and hold them long term. And here's kind of how you get repaid for that. So we came off of those 20% lows, and a lot of those names are 15, 30% higher than they were back then.
And not just the move off the low, Sylvia, the speed of the move.
The speed of the move
was amazing.
Right.
All right, stick around, because joining us now is Rob Hayworth. And Rob is Senior Investment Strategist at U.S. Bank Wealth Management, which has $505 billion in assets under management. Rob, it is great to see you. So you say here, Rob, we remain glass half full with our investment outlook. Why half full, Rob? Walk us through it.
Yeah, great to be with you, Josh. I think the challenge is negative 0.5% GDP growth in the first quarter of the year. A lot of that was imports But the challenge is the consumer is softening a bit, and there's some challenges, especially in the lower income cohort, that we have to be careful for. So we think this is a market that can still climb this wall of worry, but it's not as robust as it was, right? So we think we're in middling sort of economic growth scenarios, 1 to 2%. And then you take a look at what that means for S&P 500 earnings. Right now, consensus is around 7% for full year 2025, 13% for 2026. That may be a little too robust when we think about the economic backdrop that we're facing, where the market is really being driven, as was pointed out. There's a recovery in place. There is a lot of hope for more artificial intelligence spending growth, and I think that's been helping to drive the market. There's okay news for the consumer, but we think that there are some risks out there that we have to watch and adapt to as we move forward. But it's still half full, so we still think this is a constructive environment, just not one that is robust and has many risks.
Broadly, Rob, how would you characterize valuations? I'm guessing, given what you're telling me here, you'd say they're a bit stretched.
No, definitely within the S&P 500, you're at what we sometimes call the high end of fair, right? You're on that rich side of valuation. And the challenge, I think, is things need to go exactly right for the market to continue to press ahead. Now, they certainly can. We continue to see good news on artificial intelligence spending, certainly the broadening of this rally into industrials, into financials, into other sectors outside of technology and communication services is extremely constructive. So we think this is a market that can continue. But interestingly, you look around the world, global diversification may pay off just as well. You have cheaper valuations. It's a little maybe easier for them to overcome that downbeat current pricing that you have outside the U.S. So global diversification probably becomes important as we look into the back half of the year.
What about the big, beautiful bill, Rob? It's being debated right now in the Senate. That gets passed into law, Rob. What do you think that means for the markets? We have had strategists and economists on the show who say they think that's all baked in. It would only be big news for the market, they argue, if the tax cuts didn't get extended. But I'm curious to get your thoughts.
Yeah, I think the market very much expends the tax cuts, and especially the 2017 Tax Cuts and Jobs Act, to get extended, right? But Congress doesn't really have to get that done until it expires at year end. In the meantime, they have other issues they really need to address. One is the debt ceiling, with Treasury Secretary Bessent talking about the X date being somewhere mid-August. We definitely need to get that resolved. And two, the current budget expires September 30th. We definitely need to get that resolved. The reconciliation bill currently under consideration would certainly address all three of those factors. The market is pricing that, and you have maybe some benefit in the back half of the year that offsets some of the cost of tariffs, which still remains unclear exactly where we're going to settle out in terms of the impact on both inflation and economic activity that we're going to get from tariffs, because we don't have enough deals yet in place to understand where we're going to settle out.
Let's talk about the Fed as well, Rob. Just curious to get your thoughts there. I mean, it sounds like Jay Powell is comfortable with sitting on his hands. We have had strategists on the show recently, Rob, who actually told me they agreed with Waller and Bowman, and they think the Fed should be thinking about cutting next month. Their point to me was, listen, they think inflation's in check. They think we're slowing. They say the labor market's cooling, and they believe it's going to get colder. What do you think?
Well, I think the hard part is the Fed does tend to look a little backwards. And if you look at the data most recently, you're really not seeing tariff impacts come through in the inflation data yet. Maybe it doesn't. Maybe it comes through in terms of earnings expectations. That could be a different sort of challenge. But when we look at the most recent May PCE data for inflation, right, you saw it tick a little higher. You saw it tick a little faster. So that doesn't really give the Fed a lot of room to cut rates. And the labor market remains really pretty solid. I mean, that's some of what helps us think about this as a glass half full. Is jobless claims remain modest at 240, the unemployment rate at 4.2%. Yes, consensus is we get to 4.3% in June, but that's still quite low. And we continue to add payroll jobs. Now, at a more modest pace, 115,000 is what I've seen for consensus for the June report coming out on Thursday. But there's not really a signal for the Fed that they absolutely have to hurry and cut rates like we had in September last year when we saw a 40 basis point uptick in the unemployment rate, and the Fed felt they really needed to cut rates to save the labor market. They did. We've had that unemployment rate hold in at 4.2% for quite some time. We just don't have enough signals, I think, for the Fed to feel the need to move quickly yet.
And finally, Rob, for fixed income investors who are listening right now, your advice?
One, high grade bonds are paying you the best incomes you've had in 10 years. So diversification is actually starting to pay off in portfolios when you think about a stock bond mix. Two, we would look to really harvest extra income and look at more esoteric sectors with solid fundamentals that are offering you higher incomes, like collateralized loan obligations, mortgage bonds that aren't backed by by government agencies. And then we'd also look at things that aren't correlated to the business cycle, like reinsurance or catastrophe bonds, where you're getting really strong yields for the last 3 years. We expect that to continue. So there's lots of room for diversification for fixed income investors as well.
Rob, always great to have you on the show. Thank you, sir.
Thank you. Great to be here.
Stick around. Much more market domination overtime still to come. The U.S. and Canada trade negotiations hitting a turning point on Sunday. Canada saying that it's rescinding a digital services tax on the U.S., the move coming as trade talks stall between the two countries. For more now, we're going to bring in Vipal Monga, reporter at the Wall Street Journal. Vipal, it is great to have you on the show. Maybe start, Vipal, high level and simple here. Can you just explain to the audience, when we talk about a digital services tax, Vipal, what is that tax? What are the kinds of American companies that would have been hit by it, Vipal? And how much did Canada think it would collect off that tax?
So digital services tax in Canada amounts to about a 3% tax on the revenues of companies like Meta, Amazon, Facebook. The theory is that a lot of those companies provide services to Canadians, get revenue from Canadians, but aren't taxed on that revenue at all. And so Canada was trying to look to kind of close that tax gap. Other countries have taken that same tack, France, the UK, a lot of European companies are looking into it. And Canada estimated that the tax that they implemented was retroactive till 2022, and they would have brought in something like $3 billion today when the tax was when payments were supposed to happen on the tax. So it's quite a fair bit of money, not tremendous amount, wouldn't have broken or made the budget, but it was a question of fairness, really. A lot of these digital companies are seen as skating through the global tax system, and Canada wanted to address that.
And Vipal, would that tax have been retroactive? It
would have been retroactive to 2022, I believe. That was a real issue.
I'm sorry, go ahead, Vipal.
Real issue for these companies, that not only was it a big 3% tax that they don't have to pay now, but it would also be going back in time, and they weren't happy about it at all.
I'm curious, Vipal, as you were doing your reporting on this story, did Trump make it clear to the Canadians and to Carney how upset he was by this and that he was going to end trade talks before he posted about it on social media?
So it's not just Trump who said that they've been upset with the tax. The Biden administration also hated the tax. It's been a lingering issue for Canada-U.S. relations. The question was, why hadn't Canada removed it sooner? Trump also brought it up with Carney at the G7 summit that happened earlier in June. Canada kind of brushed it off a little bit. And in fact, on June 19th, the Canadian finance minister doubled down and said that they were going to implement it come hell or high water, effectively. That's the thing that really set Trump off, and that's why he tweeted on Truth Social. He gave no warning to the Canadians before he tweeted, or truthed, I guess.
Vipal, Trump likes to say he holds the cards. The U.S. holds the cards when it comes to Canada. Is that accurate?
Well, based on the events of the past 3 days, it's hard not to argue that he's right. I mean, he does have a lot of cards, and Canada, for all intents and purposes, for all its talk of elbows up and taking a strong stand against the U.S., caved. I mean, Caroline Leavitt said it, and it's accurate. Canada caved in a way that really weakens their hand going forward. Now, Canada has a lot of things that the U.S. needs, a lot of natural resources, oil, for one, critical minerals, and Canada's been hoping that that's enough to convince the U.S. to play ball. However, the U.S. also realizes that Canada has no other customers for these valuable products at this point. So it seems.
Sylvia, Vipal, who's done some great reporting on this, how does the market think about this dynamic and this issue?
Well, I think that the market thinks that Canada blinked first, and I think that the market is very happy that Canada blinked first, right? We're talking about the Mag 7 companies. So anytime you have some sort of tariff or some kind of negative impact that can go to the bottom lines of the Mag 7 companies, that's just something that the market doesn't like. And I think that the more we hear about tariffs, the more we want to hear about things like this happening, that there was a deal made and that, XYZ blinked and made a deal with us.
Vipal, I think we got you back here. I'm just curious, Vipal, as you were reporting this, and listen, you've done such great reporting on it. What was strange to me is, and maybe I have the timeline wrong, the Canadians must have known, Vipal, that this would have upset Trump, right? That he would be so frustrated by this. So I'm just trying to understand the strategy from their viewpoint here.
I think a lot of people are asking that question right now. It's very bad strategy, right? That the Canadians have at this point. It makes them look very weak against a president that feasts on weakness. So I'm not sure it was a good move. Better play might have been to say that they're pausing the tax, not rescinding it, and hold it in reserve. But they didn't do that. They basically gave it all away.
Vipal, great to have you on the show today. Thanks so much for your time and the great reporting.
Thanks, guys.
So Sylvia, one last question. I mean, listen, we talk about some of the risks for the market. We've got Q2 earnings coming up. How, as an investor, are you thinking about trade deals? I mean, we have a July 9th deadline coming up. Not sure what's going to happen. Maybe the White House has sort of suggested that's not exactly set in stone, though.
Yeah, I think that the market is just waiting to hear. But what we're seeing now actually is that investors are more focused, I think anyway, on AI and innovation and how that's that's how that's going to move the economy. And this became almost an afterthought. It was our focus for the first half of the year was arguably tariffs and geopolitics. And just as of the last week or so, it's all back to kind of AI and quantum computing. So I just think that investor sentiment has shifted and investor fears and risks have shifted a little bit. But all we need is some bad news.
Did you
turns it around?
When Trump posted this, and he was clearly very frustrated with Canada, and he posted it and he says, "That's it, I'm ending talks." Right, very frustrated. And and you saw the market dip a bit on it, but then it was like the market just kind of shrugged it off. What does that tell you?
I think that his high, it feels as though his high stakes poker with trade tariff negotiation is actually working, right? We come in hot, the whole market crashes because we're worried about the future of every single corporation in this country and what their expenses will be. How can they keep up with this? GDP will have to suffer, inflation will be an issue. And so far, I mean, lo and behold, tariffs are higher than they were a year or so ago, and nothing has happened, and we keep climbing higher. So I think that a lot of people are kind of scratching their heads about, when is this going to impact the markets? But I think the longer kind of the can gets kicked down the curb and tariffs stay at bay, all of the positive news that we have in the markets, like earnings, strong economy, things like that, are what's driving it forward. But I just think that the focus of the markets right now is AI and the future of that versus maybe some of the risks we were worried about a few months ago.
Yeah, that AI megatrend back in focus for sure.
Yeah.
In the driver's seat.
Yeah.
All right, more than half of all S&P 500 companies scrubbed DEI from annual reports in 2025. For more, we're bringing in Yahoo Finance senior legal reporter Alexis Keenan. Alexis.
Hi, Jess. Yeah, so we're kind of rounding out the proxy season here, and we like to take a look back at the shareholder proposals, both for DEI initiatives and against them, and corporations focusing on those efforts. And the votes are mostly in here. And again, this year, we have shareholders really roundly rejecting both types of measures, with none of them receiving majority shareholder support. So on the pro side, what we're talking about here are considerations like the board adopting diversity policies, also adopting LGBTQ plus inclusion strategies, and also for companies to focus more on things like human rights. Now, on the anti side, the proposals have things like ceasing DEI efforts altogether, or at least reporting the effectiveness of those policies. So I've been crunching some data from the law firm Freshfields. Others track this data too, like ISS. And these DEI-related proposals among S&P 500 companies, that's what we're looking at in this particular instance. In total, there were about 65 DEI-related proposals. Now, that definition can vary from firm to firm a little bit, but compared to 2024, these numbers are down about 34%. 29 of these proposals actually got to a vote as of June 16th, and 4 were still pending. About 26 of those were considered anti-ESG. Now, on top of that, you mentioned there coming to me that there were 60% actually fewer companies that included DEI references in their 10Ks, in their annual reports. So that was a big number that jumped out at us here at Yahoo Finance. And then on top of that, you had 200 plus companies removing the actual words diversity and equity. So really shying away from that kind of verbiage there. Now, I was talking today with the CEO of As You Sow, the nonprofit advocacy group, their CEO, Andrew Behar. He was saying that while the resolution numbers are down for DEI, that there's really momentum still, and he points to rejection of the anti-DEI proposals as a win for the proponents here. He points to shareholders rejecting measures at Apple, at Goldman Sachs, at Costco, Levi Strauss, Deere, Berkshire Hathaway, Disney. So big firms, he said, that's really important. He also said, though, and I found this super interesting, that there's a lot of uncertainty now for companies that are federal contractors, because if you remember back to the January executive orders from President Trump, there was one that precludes federal contractors from engaging in DEI efforts and having these kind of things as part of their policies. So some of those are subject to challenges. And now that the Supreme Court on Friday has said that the district courts don't have the ability to issue a sweeping nationwide injunction in order to put those on hold, he said, that has cast a lot of uncertainty into these companies that are trying to figure out what they should be doing. So still more to come, more tracking to do, but we're at the end of this proxy season and able to look back at these numbers and seeing that a lot more of the same, a lot more rejection, but the numbers are indeed down.
All right, Alexis, thank you. Appreciate it. And of course, a big thank you to Sylvia Jablonski for hanging with me today. Sylvia, any final thoughts for the audience?
Thanks for having me, Josh. And my final thought is, look where the puck is going. Look at the new and fast-growing industries that you have an opportunity to get into at their infancy. So quantum computing, for example, look at the stocks that make up some of that space. Look at the next gen of AI and technology, energy. We talked about Oklo before, but there's a lot of great stocks out there.
We talked Oklo, we talked robots, robo-taxis.
Yeah, exactly. Yeah. I think look to the future, because that's where the growth potential is, and it's a good, stable market. Follow the momentum, and have a great 4th of July.
Good lessons, all of them. Thank you so much, Sylvia. It was great to have you here. Appreciate it.
Thank you.
That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after closing bell. But don't go anywhere. On the other side of the break, it's Ask for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.